Have you ever wondered why some people seem to have a natural knack for handling money while others struggle? The secret is not in the size of their bank accounts, nor in their luck. It's about financial literacy, the understanding of how money works. Imagine two individuals, one who understands the principles of investing, saving, and budgeting, and another who spends without considering the future. The former, with time, will likely build wealth, while the latter may find themselves trapped in a cycle of financial strain. Financial literacy is more than just understanding numbers. It's about making informed decisions that shape your life. It's about knowing how to budget, save, invest, and plan for the future. It's about understanding the difference between wants and needs. In this complex world, financial literacy is a survival skill. Knowledge is power, and in finance, it can mean the difference between a life of struggle and one of comfort and security. Our first lesson revolves around the concept of interest. So, what is interest? In its most basic form, interest is the cost of borrowing money, or alternatively, the income earned from lending money. It's the extra amount you pay or receive on top of the original amount known as the principal. There are two main types of interest, simple and compound. Simple interest is calculated on the principal alone, while compound interest is calculated on the principal and also on the accumulated interest of previous periods. Understanding interest is crucial because it affects almost every aspect of personal finance, from your savings account to your mortgage payments. It's the engine that drives the world of finance. The more you understand about interest, the better you can navigate this world and make informed financial decisions. Always remember, when it comes to interest, time is money. Our second lesson is all about the power of saving. Now, saving might seem like a simple concept, but it's a mighty tool in your financial arsenal. You see, it's not just about stashing away large sums of money. Even the smallest amounts, when saved consistently, can accumulate into a substantial nest egg. And here's where the magic happens: compound interest. It's interest upon interest, the snowball effect in the world of finance. When you save and let your money earn interest, then that interest also starts earning interest over time. It's like a money-making machine that works while you sleep. So how do you harness this power? Start saving, no matter how small the amount. Make it a habit. Remember, the earlier you start, the more time your money has to grow. The secret to growing wealth is as simple as saving early and often. Lesson 3 brings us to the heart of financial management: budgeting. Now, budgeting might seem like a daunting word, but it's simply about knowing where your money is going. It's like a roadmap for your finances, showing you what's coming in, what's going out, and most importantly, where there might be room for savings. Why is budgeting important, you ask? Well, it's a way to control your money, instead of letting your money control you. Budgeting helps you make conscious choices about spending and saving. It's like putting on a financial seatbelt. It keeps you secure and helps you avoid impulsive spending detours. Picture this: you're in a supermarket and you've got a list. That list is your budget. It keeps you focused, prevents you from loading your cart with unnecessary items, and ensures you leave with what you need. So remember, a budget is not a restriction, but a tool for financial freedom. Lesson 4 is a crucial one: avoiding debt. Debt, like fire, is a good servant, but a bad master. It can help you achieve your goals, but it can also lead you down a path of financial ruin. It's important to understand the difference between good debt and bad debt. Good debt is seen as an investment that will grow in value or generate long-term income. For example, taking out a loan to start a business or to buy a house can be considered good debt. On the other hand, bad debt is debt that's used to purchase things that quickly lose their value and do not generate long-term income. This could be things like credit card debt from buying the latest gadget or clothes. Living within your means is key to avoiding bad debt. Remember, if you can't afford it, think twice before borrowing to buy it. Lesson 5 is about preparing for the unexpected: emergency funds. Life is full of surprises, and not all of them are pleasant. A sudden job loss, a medical emergency, or a major car repair, these are all situations that can throw your finances off balance. That's where an emergency fund comes in. It's a safety net that cushions you against financial shocks. But how much should you save in your emergency fund? Financial experts recommend having 3 to 6 months' worth of living expenses. This amount can cover your basic needs if you're faced with a financial crisis. However, the exact amount depends on your personal circumstances. If your income is irregular or if you have dependents, you might need to save more. Remember, the goal is not to build this fund overnight. Start small, save consistently, and gradually build your fund. An emergency fund is not a luxury, but a necessity. Scene script. Lesson 6 brings us to the world of investing. Picture a seedling. With proper care and nurturing, it can grow into a towering tree. The same applies to your money. When invested wisely, your hard-earned dollars can grow exponentially, providing a significant financial cushion for your future. Investing is a crucial part of wealth creation. It's not about instant gratification, but rather about playing the long game, focusing on the potential for future financial growth. It's about making your money work for you. There are various forms of investments to consider, each with their own advantages. Stocks offer potential high returns, bonds provide reliable income, while real estate can bring both income and value appreciation. Mutual funds and exchange-traded funds offer diversification, spreading the risk across multiple investments. It's essential to remember that investing involves risks, but with careful planning and due diligence, these can be managed effectively. Investing is not just for the rich, it's for anyone who wishes to secure their future. Lesson 7 is all about understanding taxes. Now, taxes may seem like an unavoidable burden, but they're actually an essential part of our society. They fund public services, infrastructure, and many other aspects that make our lives better. But why is understanding them so crucial for your financial management? Well, taxes can significantly impact your net income. They come in various forms like income tax, sales tax, property tax, and even capital gains tax. Each of these can affect your financial decisions in different ways. For instance, knowing about income tax brackets can help you plan your income strategically. Understanding sales tax can influence your spending habits. Being aware of property tax can guide you when buying a home. Moreover, knowing how to navigate tax deductions and credits can potentially save you a lot of money. It's like a puzzle. The better you understand it, the more pieces you can fit together to your advantage. Remember, it's not just about how much you earn, but also about how much you keep after taxes. Lesson 8 brings us to the long-term, retirement planning. Now, this may sound like a topic for your future self to worry about, but let me tell you, the earlier you start planning, the brighter your golden years will be. Retirement planning is essentially setting aside money today, so your future self can live comfortably without a regular income. The magic ingredient here is compound interest. The longer your money is invested, the more it grows. Here's how it works. You earn interest on the money you save, and over time, you start earning interest on that interest. It's like a snowball effect. The earlier you start, the bigger your snowball gets. Imagine a comfortable life post-retirement, doing what you love without financial worries. That's the power of early retirement planning. It's never too soon to start. Remember, every penny saved today is a step towards a financially secure retirement. Retirement may seem far off, but the best time to plan for it is now. Lesson 9 is about continuous learning. In the realm of finances, knowledge truly is power. The most successful people in the world didn't get there by accident. They continuously educated themselves and stayed proactive in their learning journey. You don't need a degree in finance to make smart money decisions. Resources abound for those willing to seek them out. There's a wealth of information at your fingertips, from books to online courses, all designed to help you understand and navigate your financial landscape. Financial advisors can also provide valuable insights tailored to your specific situation. But remember, the responsibility of your financial well-being ultimately falls on you. Just as you would keep up with the latest trends in your field of work or study, it's necessary to stay updated with financial trends and policies. This will allow you to make informed decisions that could significantly impact your financial future. Remember, financial education is a lifelong journey, not a destination. Lesson 10 reminds us that insurance matters. It's an essential tool for managing risk in our lives. Let's delve into why. We have health insurance, which provides financial coverage for medical expenses. It's like a financial shield against unforeseen health crises that could drain your savings. Then there's life insurance, a crucial safety net for your family, providing them financial security in the event of your untimely demise. Next, we have property insurance, safeguarding your valuable assets, be it your home or your car, against damage or loss. In a nutshell, insurance is your financial bodyguard, stepping in to bear the brunt of unexpected financial blows. It allows you to transfer the risk of a potentially large loss in exchange for a comparatively small premium. So when we look at insurance, we shouldn't see it as an expense. Rather, it is an investment in peace of mind. Insurance is not a cost, but a safety net. Lesson 11 is about not putting all your eggs in one basket. Diversification. You see, diversification is a key principle in managing your investments. It's about spreading your money across different types of investments, such as stocks, bonds, real estate, and even commodities. Why do this, you ask? It's simple, really. By spreading your investments, you're effectively spreading your risk. If one investment doesn't perform well, it doesn't spell disaster because your other investments can help offset that loss. But let's be clear, diversification isn't a magic bullet. It doesn't guarantee you won't lose money. What it does is it helps to smooth out the bumps in the road, so you can weather the ups and downs of the market with a bit more ease. Remember, investing is a marathon, not a sprint. Diversification is not about making a lot quickly, but about securing steady growth over time. Lesson 12 is about understanding your credit score. Imagine it as your financial reputation, a number that sums up how trustworthy you are with borrowed money. The higher your score, the better you look to lenders, landlords, and even potential employers. So, what makes up a credit score? It's a mix of factors like your payment history, the amount of debt you owe, the length of your credit history, and the types of credit you have. Now, building a good credit score takes time and discipline. Always pay your bills on time, even if it's just the minimum payment. Keep your credit card balances low and limit the number of new accounts you open. Maintaining a good score is just as important. Regularly check your credit report for errors and take steps to correct them. Remember, a good credit score can open doors to opportunities like lower interest rates on loans. Your credit score is your financial reputation. Guard it diligently. Lesson 13 is about the art of negotiation. Negotiation is a key skill not just in business, but in all aspects of life. Particularly in financial matters, it can make a world of difference. Whether you're negotiating your salary, the price of a car, or terms of a house mortgage, the ability to negotiate effectively can save you a lot of money. So how can you become a better negotiator? First, do your homework. Know what you're buying, what it's worth, and what you're willing to pay. Second, don't be afraid to ask for what you want. The worst they can say is no. Third, be willing to walk away. If the deal doesn't meet your needs, don't be afraid to say no and try somewhere else. Negotiation is a dance, a back and forth that requires patience, confidence, and strategy. It's about finding a win-win solution that benefits both parties. Remember, everything is negotiable. Lesson 14 is about making saving easy. Automate it. In the world of finance, automation can be your best friend. By setting up automatic transfers from your checking account to your savings account, you're not only ensuring consistency in your savings, but also eliminating the temptation to spend that money elsewhere. Imagine, every month, a portion of your income automatically trickles into your savings account without you having to lift a finger. This effortless method of saving can have a significant impact on your financial health over time. It's like creating a safety net for yourself, one that grows steadily and surely without the risk of impulsive spending eating into it. In essence, automating your savings is a commitment to your future self. It's a way of prioritizing long-term financial security over short-term desires. So, take the first step today and set up automated savings. Remember, automating savings is like paying your future self first. Our final lesson, 15, reminds us that patience is a virtue. In the world of finance, patience is more than a virtue. It's a necessity. It's easy to get caught up in the excitement of quick gains, but sustainable, long-term financial health requires time and consistency. It's a marathon, not a sprint. This is particularly true when it comes to investments. While some may promise immediate, substantial returns, they often carry higher risks and could lead to significant losses. Instead, consider the power of compound interest, which can significantly grow your wealth over time. With patience, a steady investment strategy can yield impressive results. Similarly, financial planning is not a one-and-done affair. It's a lifelong process that requires patience, discipline, and constant adjustment. It's about setting realistic goals, making informed decisions, and staying the course even when things get tough. And beware of get-rich-quick schemes. They often overpromise and underdeliver, leaving you worse off than you were before. Remember, in finance, slow and steady often wins the race.